Welcome back to your personal finance classroom, where we break down your money questions to make it easy for you to live your best life. Don't forget to subscribe and hit that notification bell so you can be notified when new videos come out. And if you found this video helpful, don't forget to like it. Today, we're continuing our credit score series to talk about what a good credit score is. Just like most of the questions we answer in our lessons, there isn't one straightforward answer. There are different scoring formulas with score ranges that vary, as well as different lenders with different types of loan or credit that have their own standards for rating credit scores. In this lesson, we'll break down what the range for good and bad credit scores are and what to do if you aren't happy with where your score falls. Your credit score is a 3-digit number calculated from the information on your credit report and can generally range from 300 to 850. That score gives lenders insight into how risky it is to loan money to you and whether you're likely to make on-time payments. You might notice that if you check your score in different places, you have different scores. In general, there are two main credit scoring models, FICO and Vantage score. Both formulas consider similar aspects of your credit history, but they each use their own formula to calculate the score. We will note that in general, a FICO score is the more popular scoring model to use among lenders, but it's helpful to understand both. Some things that factor into your credit score are on-time payments, how much debt you have, the length of your credit history, and your credit utilization ratio. Having a good credit score is important when it comes to helping you meet a lot of your personal and financial goals. With a good credit score, you have access to things like higher credit limits. A good credit score means that you're trustworthy and you've likely got a history of making on-time payments. This, in turn, means that lenders are more likely to lend you money. It means potentially lower interest rates. When you're considered a responsible borrower, you might have the option for lower interest rates. Interest is the cost to borrow money. Good credit score, you can have more purchasing and negotiating power. If you're looking to buy a house or a car, a good credit score might give you more ability to negotiate on price. With a good credit score, you'll likely have more offers and lenders to choose from, which gives you more negotiating power. And credit scores can even impact non-lending decisions, like whether a landlord is willing to rent an apartment to you. So let's break down the different credit score classifications. A very poor credit score ranges from 300 to the low 600s. A poor credit score can make it difficult to get approved for a loan or credit card. With a poor credit score, you might find that you have less options and there are higher interest rates on the options that you do have. And as mentioned, you might have difficulty renting an apartment, and in some cases, it can impact whether you get a job. Make sure you subscribe because next Wednesday, we're continuing our credit score series with a lesson on how poor credit might have the potential to impact a job search. But if you're in the poor range, all is not lost. You still have options. We'll discuss ways to improve your credit score later in this lesson. A fair to good credit score ranges from anything in the low 600s to the mid 700s. A fair credit score still means risk for lenders. There may be less options available in this range. And while a credit score that's considered good might sound like a positive thing, it's still an area where you want to consider a strategy to improve your credit. In the good range, you'll likely have a few more options and access to average interest rates. Stay tuned for tips on improving your credit score later in this lesson. A very good to excellent credit score is considered anything above the mid 700s. With a very good or excellent credit score, you're likely considered less risky and most likely to be approved for loans and credit cards with lower interest rates and more favorable terms. If you're curious, the highest credit score you can get is an 850. It's important to note, though, that a perfect credit score doesn't necessarily mean that you'll have access to even lower interest rates or apply for special credit cards. There isn't much of a difference in what you have access to once you're in the very good to excellent range. Let's get a little more specific. When it comes to your FICO credit score, very poor is considered 300 to 579, fair is considered 580 to 669, good is considered 670 to 739, very good is considered 740 to 799, and excellent is considered 800 to 850. And for your Vantage score, very poor is considered 300 to 499, poor is considered 500 to 600, Fair is considered 601 to 660. Good is considered 661 to 780. And excellent is considered 781 to 850. In general, scoring formulas consider things like on-time payments, your credit utilization ratio, the length of your credit history, the variety of credit accounts you have, and any hard inquiries on your account. If you want to know more about the specifics of what goes into your credit score, check out our lesson on How is my credit score calculated? We'll link that in the description. If we've gone through this list and you realize that your credit score isn't within the range you want, there are ways to improve your credit score. Here are a few. If your credit score is in the poor range, consider applying for a secured credit card. A secured credit card works like a regular credit card. The difference is that you're offering up money in advance as proof that you can pay. So, for example, if you applied for a secured credit card and put down $200 as a deposit, your secured credit card will have a $200 credit line. If you put down $500, you'll have a $500 credit line. The bank holds onto that deposit for the life of your secured card. You would use the card as you would a normal credit card and continue to pay off the balance, or at least the minimum, each month. Continuing to use and pay off your secured card helps you build up a solid credit history. It's also important to make your payments on time. This one might be an obvious one, but missed or late payments can have a negative impact on your score. Set reminders or schedule automatic payments so that you'll always be on time with your payments. Keep your credit utilization down. Your credit utilization is how much credit you're using compared to how much credit you have available. If you have a single card with a $1,000 balance and you regularly spend $100 on it, your credit utilization is 10%. Compared to if you're regularly spending $500 on the card and your credit utilization is 50%. It's a good idea to keep your credit utilization below 30%. And limit new account applications. New credit card applications or loan applications often mean a hard check into your credit. Too many hard checks, especially within a short window of time, can have a negative impact. Be strategic with when you're applying. Keep in mind, it may take anywhere from 6 months to a year to improve your credit score. The key is consistency. Make sure to follow the steps we mentioned to work on improving that score, and check in with your score every few months to track your progress. And if a low credit score is a result of struggling with debt paydown, check out our video on reliable ways to pay off debt. We'll link that in the description. Don't forget to like and subscribe. We'll be back Wednesdays and Fridays with new personal finance lessons for you.